This is Valentina Sanchez from the Bird Shops Report. Welcome or welcome back to another episode of The Lens with Craig Shapiro and Larry McDonald. We're pretty excited to have you today and enjoy the video.
Thank you, Valentina. Are we good to go? Okay, we're good to go, Jose? Hello?
Yes, sir.
Okay, great. Craig Shapiro, good to see you, my friend. It's been a crazy week. We're at the Harvard Club of New York. We hosted institutional investors last night and family offices. Special thanks to the Harvard Club. Outstanding evening. Really triangulating information, talking to some of the best and brightest investors in the world. And that's the whole point of the lens and our one idea. And that's Craig Shapiro and Larry McDonald connecting our network to a broad audience, bringing democratization to information. Craig, crazy week. I want to go through kind of your take because you've been right on the front lines all week. I've been on the road. When you're talking to the institutional chats in our Discord room, our clients globally, when you're in there this week, what observation from the institutional investors and anybody that wants to be in our Discord room or our Bloomberg chat, please reach out to our info email. Craig, what are you hearing this week?
Yeah, this week I think was a little bit of trader exhaustion, right? I mean, the pace of information releases that we've been getting, since the administration came into power in late January, accelerated after Liberation Day earlier this month, and volatility has been incredibly elevated, and the pace of news flow has been incredibly elevated with respect to tariffs and reciprocal tariffs, and then retaliation, and then the pause. And volatility has just been kind of headline risk has been ample. And so this week has brought a little bit of a calm, some digestion. The volatility has started to wane a bit, which isn't surprising. We couldn't necessarily maintain those levels of and that speed of information so much. So this week brought a little bit of a pause. But I think traders and investors are kind of waiting for the next shoe to drop from Trump. Are we going to have momentum on the trade deals or not? Are we going to ratchet up further retaliation against China or not? And what we learned yesterday from Fed Chair Powell was that the Fed really is in no position here to provide any further accommodation at this point to the economy. So the ball's back in Trump's court here on the tariffs, and people are kind of sitting around a bit waiting to see what comes next.
But Craig, what's different in the market today versus say, 2 months ago? In other words, the one takeaway that I've been getting especially from last night and talking to some of the largest hedge fund managers in New York, one of the gentlemen at the table said this quote, which I thought was really powerful. He said that the Sunday night phone calls that he's had in the last 3-4 weeks were on par or even greater, the intensity and the anguish and the anger than the Lehman days. In other words, pension fund managers globally, and these are large pension funds that have had incredible trusts in the United States for decades. They feel like they just get hit with a 2x4 on the spending, another $1 trillion of deficit spending, in the first quarter of this year. And then the interest as a percentage of tax receipts is up near 20%. We're starting to act like an emerging market country. And then in comes Trump with the sledgehammer on this tariff taxation. And the anguish that this client has been experiencing on those Sunday night phone calls, he said, was on par with Lehman. And his main point, Craig, and you're a great FX guy. His main point is that the trend shift you're seeing in the dollar, this really potentially has a lot of legs.
Yeah, it's been years, if not decades, where we've had this U.S. exceptionalism trade, U.S. growth outperformance, company outperformance, profit outperformance, aided by significant stimulus and deficit spending. But that narrative is starting to fall apart a bit for a variety of reasons. First off, the domestic stories in Europe, in China, in Japan about infrastructure spending, defense spending, consumption-related spending is providing a little bit of a backdrop here for some of that money to go home, where previously, we didn't necessarily have that narrative. But really, more importantly, it's about what Trump is doing with respect to trying to weaken the dollar, bring back manufacturing to America, and threats of taxation on foreign holdings of U.S. Treasuries and U.S. assets. Talks about further sanctions on enemies or whoever. Discussion about removing Chinese listed equities from U.S. exchanges is giving these international fund managers pause, caution, angst, a variety of different adjectives that makes them say, you know what, this outperformance that the U.S. has had for decades, we need to start bringing some of this money home.
Right.
This isn't going to last.
So let's look at the slides. There's a slide that we have that an institutional client pointed out today, the Aussie dollar. So if you think of, like, say you're an institutional investor, you lost money on your stocks in the last month, you lost money on your bonds, and you lost money on your FX. And to me, this slide, and this was sent to us from one of the most successful asset managers in Europe. And he said, look at the rate of change, Craig, in the Aussie dollar. In other words, his point is, if you're a global fund manager and you've been massively overexposed to the dollar, right? And now all of a sudden you have to shift, you have to sell dollars and move into a basket of other currencies. One of those currencies might, oh, by the way, be the Aussie dollar, the Canadian dollar. In other words, instead of having two standard deviation more exposure to the dollar than the 40-year mean, which has been the case, they're kind of diversifying into a basket of global currencies. Craig, what do you see here? I mean, look at that move in the Aussie dollar there, and look at that move in commodities versus equities.
Yeah, I think you're right here. I mean, global investors have felt very comfortable in the U.S., have felt very comfortable in treasuries as their neutral reserve asset. And so when Trump is talking about this massive shift and potential reordering of global trade, these reserve managers and these investors have to find other places to store wealth. And so we're seeing some of that repatriation. The euro has had a tremendous move here over the course of the last several weeks. The yen has appreciated. We've seen this in commodity related currencies, like you mentioned, Aussie dollar, Canadian dollar, and most, I think, importantly, we're seeing it in gold, right? We're definitely seeing a breakout in gold over the course of gold's been strong for a while. We've been all over this, but the acceleration in the gold price move over the last month or so, I think, has been investors realizing that gold will act increasingly as that neutral reserve asset. And so we're certainly seeing more and more flows into the gold miners and into the gold price.
And special thanks to you, Craig, and Robert, and our team at Penguin. I mean, we produced this book over the last, we started writing it almost 2.5, 3 years ago, right? And one of the chapters in the book is about cold, hard assets, and a shift from financial assets, which are stocks and bonds, over to hard assets, gold. And you've been a gold bull. There's a major gold component to the book. There's a major Bitcoin component to the book. What are we seeing here, Craig? This one thing clients are pointing out to us is that, Nvidia's lost about $1 trillion of valuation. Where's that money going? And it's really bizarre that as we have economic risk that's rising, according to all measures, even though I think there was a regional Fed data today, all measures show you that economic risk is rising. But, oh, by the way, like, how are the oil names and the copper names doing relative to tech?
Yeah, I mean,
how do you explain it?
Yeah, you can see from this chart, they've started to break out on a relative basis. I mean, the overweight in the indices to big cap tech has been monstrous for quite some time. And so what you have is you have little moves, or as some capital flies out of big cap tech, the percentage gains that you get on these smaller sectors like materials, like energy, are outsized. And so what you wind up having is
right. That is strength. Such an important point. Thanks. Say that one more time so everybody can understand.
Yeah, I mean, to your point, Larry, a $1 trillion market cap reduction at a Nvidia. I think the entire copper mining universe, I think you mentioned this morning, is only a couple $100 billion, right? So if you have some of those flows that leave Nvidia and are looking for other homes, and they're not going necessarily to cash, a small move out of Nvidia becomes a large move for Freeport, McMoran, or for other copper names, or for other energy names. And so that's how you're getting a lot of this relative outperformance into a slowing economy.
Right. And let's keep the slides moving. And so and remember, Craig, you've made this point. European investors, they are table max long US stocks and Mag 7. Now look at this. Fascinating that a company like Nvidia can lose $1 trillion in valuation, and it's still at 19 times sales. Is that right? And look at
Yeah.
the rest of the Mag 7 way down there. This tells me that as clients know, we've been short Nvidia through the NVDS for sophisticated investors, very public on this. We think this trade has a lot more to go. We think the drawdown on Nvidia is going to be at least 50%. The moat, that prized moat, remember the entire street has been pounding and pounding away how safe Nvidia's moat structure is. And all that means is barriers to entry and the ability to protect the value of the company relative to the rest of the world and competitors, right? That's the moat. That moat is shrinking at an alarming rate, and that's why you see there that price of change coming back. Any question there? Any point you want to make on this, Craig, before the next slide?
No, I think what you see is just broadly speaking how cheap the S&P is on a price to sales basis relative to the Mag 7 still. And so I don't think investors are going to completely flock out of equities as an asset class, but there's going to be these violent rotations that are going to continue. And so as you get some of that selling pressure on Nvidia, on big cap tech, investors don't want to abandon equities entirely. And so they're going to rotate into where there's domestic infrastructure stories globally, or in the US, a manufacturing renaissance story as more investment comes here. So commodity related sectors, industrials, materials, energy, can pick up some of that relative outperformance.
And yeah, here you have just an ugly chart, back and fill, lower highs. You're looking at $1 trillion loss in market cap there. A lot of that's European investors. And remember, the passive investing overdose is going to go down in history. We talk about it in the book. There's a chapter in the book, How to Listen When Markets Speak. The dark side of passive investing. Too much concentration. As European investors exit, more other investors around the world kind of see that, and everybody rethinks that trade. We hit number 1 this week on Amazon. Thanks for that, Jose. Really proud. Thanks to everyone. We're so grateful. And this is a real big moment because now we have 2 global bestsellers: The Colossal Failure of Common Sense and When Markets Speak. And I want to thank David Einhorn, who helped us out in the book, David Tepper, Charlie Munger, Neil Ferguson. It's a wonderful read, and please tell a friend about it this week. Next one, Jose. So Craig, growth to value. I think that's the big message this week. So capital's moving from growth over to value.
Yeah, I mean, and that this is some evidence of that. Energy sector is a value related sector, and so you're starting to see this kind of it broke out of a trend from earlier this year, and in the sell off, it underperformed, but then now it's coming back again. So oil price is up 3.5% today. Look, I think the dollar is key. And this idea that Trump is looking to weaken the dollar structurally over time in order to bring back manufacturing to America, I think that is where the administration ultimately wants to be and gets to. And whether or not it does it properly, improperly, on purpose, by mistake, this is where we need to be. That's the only way to really bring back American competitiveness. And so assets that are priced in dollars, like hard assets and commodities, are going to relatively outperform. And so I think we're seeing that rotation makes a lot of sense.
Right. And next slide, please. Craig, you were one of the first people to point out to our clients about that Steve Marin, kind of, I don't know if that was an op-ed, but your observations on that were really powerful. And that was was that like 2 months ago? And now It's kind of playing out.
Yeah. I mean, Steve Marin, was the junior in the first Trump term, and then he went to the buy side. And he was, we didn't know if he was going to be part of Trump 2.0, but he obviously got an incredibly powerful position heading the Council of Economic Advisors, the CEA. But back in November, while he was working for Hudson Bay, he wrote a 40-page, basically a dissertation about the variety of things that the U.S. could do in order to help improve its trade balance, restore manufacturing, and help America grow under this Trump regime. And one of the things that he talked about was this idea of potentially taxing foreign capital and foreign ownership of U.S. Treasuries and U.S. stocks. And so when he gave a speech, I think it was a couple of weeks ago, where this was reiterated, and he said, "Look, these are just things that we are thinking about, or that are possibilities. This is not necessarily is imminent, but I think folks say when this is starting to be discussed at the highest levels, it's something that we need to consider." And so foreigners are saying, "Look, we have to think about acting ahead of when you decide that this might be something you want to do."
And if you're in the White House, Craig, you know that, I mean, the Navarro-Lutnick team, we think they're on the way out. They're definitely, I think, somewhat neutered now, but I mean, they got to look at this chart. This is, at the end of the day, the way they've gone about this in a little bit more reckless way. I think they should be more concentrated in certain win areas on tariffs. But this economic data rolling over today. And Craig, you made a point. One of the investors made a point in the chat. Historically, last 20, 30 years, when you see data like this, right, regional Fed data, or data that rate of change, typically you'd see right now a 10-year Treasury with a 3-handle yield, 3.5, 3.2, but you're still up in the 4.3%. So it's really a game changer type environment. Next slide, Jose. Let's go back to the Oxy. One thing I want to say, Craig, we don't know, nobody knows for sure, how accurate this is, but if you look at Bloomberg on Occidental Petroleum, Buffett's cost basis is $53, right? And we've seen a big capitulation move in the energy names over the last week, and that's that accelerate our capitulation model. We went out with a buy on some of these names last week in our 7-factor capitulation model, and you can see their real intensity selling. We think Buffett was in there over the last 10 days buying, and you can see their large volume. And at the end of the day, we think he owns a stock above 50, and Oxy's been for sale. High capitulation.
Yeah, we certainly know that Buffett has a lot of cash on the balance sheet. We know he's a hard asset guy by heart, and so I think he's kind of going to take this period of turmoil and uncertainty to pick up things on the cheap. That's been his style for quite some time, and so I think that makes a lot of sense. But I think back to that Philly Fed chart you showed and the new orders rolling over. I mean, we have an uncertainty problem in America, right? And so how does the administration bring back certainty? Investors are looking for, and companies see the benefits from the Trump agenda, the tax cuts, the deregulation, the supply side reform, lower energy costs, and they want to be there for this resurgence in 2026 and beyond. But for now, with tariffs, there's just too much uncertainty. So everyone's kind of sitting on their hands and just waiting. And that's what we need. We need some certain, whether or not we have the tariffs or not, we just need to know this is what the state of play is going to be for the next 4 years. And then I think companies will be looking forward to getting back in and investing again. But until we have that, it's just very difficult to get companies to spend, to hire, and for consumers to do the same, to spend, to travel, to spend on discretionary items. And so we're seeing a rapid deterioration in that soft data and in the economic momentum. And the only thing that's really going to stop this is bringing back some certainty.
Yeah, and Craig, you're right. That's what the global investors have told us. They need certainty. They need, we could have some move in the Supreme Court. We know the Koch brothers are kind of bringing a number of cases against the White House to try to arrest that tariff move. That's one of the observations from last night from the institutional dinner, our ideas dinner. You got movement on the Hill against basically. There are large institutional investors that think that we're about to have a constitutional crisis because of the executive branch has really flexing their muscles, right? And obviously the Supreme Court might have something to say about that this year, and obviously the Senate is already having a lot to say. Hey, Craig. By the way, when you have a flight to quality, one thing that's very dangerous when you have a moment like this is the crowding. Do you know the XLF is only 6% off the November highs, and that's the financials, JP Morgan. So everybody in kind of volatile times, everybody's running to Jamie Dimon, everybody's running to Buffett. The XLF, and this is JP Morgan, but the XLF is like 26%. Buffett and Jamie, right? So Berkshire and JP Morgan.
It's 24% Berkshire and JP Morgan combined, and then another 15% is Visa and MasterCard. So you wind up having 40% of the XLF, which people ascribe to being banks and financials, are in 4 companies that really are not, right? 2 of them are certainly flight to quality. 2 of them are toll roads on consumer spending that just kind of generally grow over time. And so, whereas back in 2008 and other periods of crisis, banks are typically at the fulcrum of those. We just haven't seen that as much this time because of again, it's the way that passive works and the way that some of these ETFs are composed. They don't often reflect kind of some of the underlying narratives about what's going on in a particular industry.
And you know what? I mean, everybody's like, right now, the AAII investor survey bearishness is, I think, 6 or 7 weeks, almost near record territory, that many weeks at this bearish level. And everybody's talking about the VIX. But guess what? JP Morgan is trading at 2 times book. That's insane. That's passive investing, just like you said. If we're anywhere near risk off in the last 30 years, JP Morgan should be down at less than 1 times book, right? And so that just shows you that either one of 2 things are going on. Either passive investing is still dramatically screwing up the market's reaction function, or people are just running to Jamie, running to Buffett, flight to quality. You've got obviously pain in the dollar, pain in bonds, pain in stocks, and maybe Jamie and Warren are now the flight to qualities relative to treasuries. They used to be the flight to quality. Yeah. But I think that's it. We want to keep this short. I want everybody to have a wonderful Passover, Easter. Thanks to the Harvard Club. Thanks to Tatiana and Jose and the entire team, and Cole and the entire team back in New York. Craig, anything, I want you to have a great holiday.
Thanks.
And enjoy your Friday tomorrow. But
yeah, it'll be nice to get a day off during the week for
yeah. I wish you were here, buddy.
And next time I'll get back. I'll get back to New York eventually.
Okay. Thanks very much, team.
Take care. Bye-bye.
All the best. Bye-bye.
Thank you, Greg. Thank you, Larry. And thanks, everybody, for watching. Please make sure you reach out to info@thebirdshopsreport.com if you're interested in any of the information or reports we mentioned all throughout this video. Also, remember, you can grab our book, How to Listen When Markets Speak, on Amazon #1 right now. Thank you for watching, and we